right, what's good, everybody? Let's jump right into it. In today's session, I'm going to talk about preparing for a seller finance transaction. All right, so for those real estate investors out there, those real estate practitioners who are interested in doing creative financing or seller finance transactions, you'll definitely want to tune into my channel. By the way, today is Monday, June 16th, 2025. For those that don't know, my name's Luther Wilson III. I own and run a small real estate brokerage here in the Kansas City area called Upside Property Services. I'm an investor, real estate broker, financier, and most everything that I do is tailored around investment properties, asset management, and investment operations. Okay, so when it comes to seller finance transactions, that's my jam. And today I want to talk about how it looks as we're preparing to do a seller finance transaction. So this may help you get an idea of how you could do a similar type of thing if you want. All right, so there are 4 things that we look at or prepare as we're planning to do a seller finance transaction. Okay, the first thing is what's going on with the property. Okay, is it vacant or is it occupied? Okay, the second thing that we're going to look at is the debt or the mortgage on the property, if there is any on the property. Okay, the third thing we're going to look at is the price and the terms that we are going to offer. Okay, and that kind of goes into how you structure it, what type of seller finance agreement or transaction that you want to utilize. And then the fourth thing is going to be marketing for potential buyers of that property. Okay, so I'm going to go through each one and kind of give examples of how we've done it here in the Kansas City market, how we're doing it today, type of thing. All right, so the first thing that's key, and by the way, from what we've seen and what we've done over the years, seller financing as an offering, as a way to exit or sell the property, where we've done it the most and where we've seen the best success with it is with single family homes. All right, but it's not just exclusive to exiting a single family home. You can use seller financing, of course, as an acquisition for not just single family homes, but multifamily commercial too. But for sake of time and our bread and butter, we're gonna focus on single family homes. Okay, so the first thing that we're gonna have to figure out or look into is what's going on with the property. Okay, is it currently vacant or is it currently occupied? Okay, are there tenants in there? Are there, a previous, a current owner in the property? Okay, we've just seen it go a lot smoother when the property is vacant. Okay, and I'll kind of get into that a little bit later. But you got to figure out, okay, the timing of it, because you don't necessarily want to jump the gun, because usually when you put the word out, people are going to want to look at the property. Okay, so you could try to stagger things and get your timing lined up, but in a lot of cases, it works best when the house is vacant or the property is vacant. Okay. Second thing is the debt or the mortgage. If there's any debt on the property, okay, which in a lot of cases there is, you gotta understand, okay, what's happening, how long is left on that underlying mortgage. Okay, is there a balloon or is there some type of adjustable rate? Okay, that's coming, are things gonna shift on the mortgage in 3 years or 5 years? Are you gonna have to pay that mortgage off within 6 to 12 months or perhaps 3 to 5 years? Okay, that second part is huge, because how the underlying debt is currently set up pretty well determines how you can exit or what type of seller finance transaction you may want to utilize, because in a lot of cases, investors are using some type of hard money loan or some type of private mortgage that they took out for the purchase and the renovation. All right, and they want to do seller financing. And I've had a number of customers or clients reach out to me and say, hey, can you bring me a buyer first while I have a short-term loan on the property? And I say no, because it adds in extra elements or multiple elements of risk, because in a lot of cases, the seller finance transaction, it's a long-term agreement. It's a long-term play or long-term investment. And if you have short-term debt or debt that has a balloon that's coming due in a relatively short amount of time, then it's going to affect how long you can go and how you can structure things. So you don't want to do a long-term agreement on top of short-term debt. Okay, so that underlying debt, if there's no mortgage on the property, even better. You can get a cleaner transaction done that way. But in a lot of cases, again, like I said, most investors, most property owners are going to have some mortgage on the property. All right, so that's the second thing that we look at. All right, the third thing that we look at is the price and the terms. Okay, so assuming that you have a 30-year or maybe a 20 or 25-year fully amortized. Okay, for us, the gold standard is a 30-year fixed rate mortgage. Okay, so you might have, like I mentioned before, use some type of short-term debt for the purchase and or the renovation, and then hopefully you've refied, or we're going to advise and encourage you to refi and get the good long-term debt in place before we even start, okay, marketing the property. That's critical. Okay, so if you haven't gone the buy, rehab, and refi route, you may have bought a property cash, or you may have just bought a property that is livable and you use some type of long-term financing. Okay, then from there, all right, the third part is coming up with the price and the terms. Okay, so you got to decide, all right, how are we going to do, what type of seller finance transaction are you going to do? Which one are you going to offer to residents as a way to exit? Okay, here in the Kansas City market, that's where we operate. I've been doing this thing for over a decade. And what we have done a lot is contract for deed or some type of wrap. Okay, and you know, lease option could be a way to go. Okay, you could even explore doing something with the existing financing, but more often than not, me and my colleagues, me and some of the other investors here in the Kansas City area, we're doing contract for deed or some type of wrap or some type of lease option. And even some investors are doing a blend or a hybrid. I don't understand that. I'm usually just doing one or the other. So based on that, you gotta determine the price and the terms. So when I have a house or a client with a property and we're about to do seller financing as an exit strategy, I need to, of course, confirm whether the house is vacant or not, how we can get in and get out, and then I'm going to confirm the underlying debt. And then, okay, I had someone, as an example, I had someone reach out last week. He said, hey, here's 2 properties that I'm considering doing seller financing on. I've worked with this gentleman before, so he kind of knew. Like, he told me, hey, I already have long-term debt on one of the properties, but if I need to, or if we end up moving forward with seller financing, he said that he could get the refi done within the next few weeks. Okay, cool, that's great to know. So then from there, price and terms. How I like to lay it out, assuming we're gonna do a contract for deed or some kind of wrap or true seller carryback, okay? I'm looking at the price, okay? I'm looking at the down payment. I gotta figure out what interest rate we're gonna look to charge the buyer or resident, and then I'm gonna figure out or look at how long it's gonna be, which again, more often than not, it's gonna be a 30-year fixed rate mortgage, okay, or a note of some type. And then based on also the taxes and the insurance. So I need to know what the yearly taxes are, and I need to know what the yearly insurance costs are, and I'm gonna plug all of that in to an amortization calculator or an AM schedule of some type, okay? So just to go through it again, you got purchase price, you got down payment, you got interest rate, you got escrow, taxes and insurance, okay? And then once you have all that, you can use an amortization calculator and you can determine what the monthly payment will be. You can come up with the monthly payment just for the principal and interest. And then when you plug in the escrow for the taxes and insurance, you come up with the monthly payment PITI, which is the principal and interest. And then you got the taxes and insurance in there, that's PITI. And then, okay, I can determine what that monthly payment is going to be, and if I think that it will be favorable for a buyer or for residents who are going to want to live in that type of home, in that type of neighborhood. Okay, for us, we will use the rental rate as a reference, and usually we may try to get a little bit more than market rent. Okay, that would be PITI. If you're going to do a note that is, fully amortized, we don't do balloons for our seller finance transactions with our residents. Okay, so price and terms, that's an example of a live one that we're probably going to get going here within the next week or so. That's if you're going to do a note that's fully amortized. Again, if you're going to do a lease option, right, you still got to determine the terms, the price. Okay, the difference with the lease option is you got the lease agreement, okay, and then you got the option agreement, okay, and then for the lease agreement, you are gonna stipulate that, hey, as part of the terms, the residents are responsible for the upkeep and maintenance. And then for the option, right, you're gonna give them a certain amount of time, of course, with some flexibility, all right, because you can't really enforce balloons on residents, okay? So you're getting into mortgage law, Dodd-Frank a little bit there. Definitely refer back to some of my past videos where I talk about things to look out for. But on the lease option, you got the lease agreement, you got the option agreement. I'm gonna be looking at giving them maybe 5 to 10 years to be able to exercise their option. And then of course, that rent amount is gonna be higher than market rent, okay? And then another thing that's key is the upfront money, okay? So on a note or a contract for deed or some type of wrap, I mentioned that you have the down payment. Well, on a lease option, it's not a down payment, it's an option fee. So it's still money that comes up front, but it's different terminology for different types of agreements and transactions. Okay, so lease option again, you got the rent, you got the option agreement, you got giving them, let's say, 5 to 10 years to be able to exercise that option. And then you got the upfront money. I went out of order. Okay, so you got the upfront money, you got the lease, you got the option, okay, however long you're gonna give them. And then on the option, you're gonna have an amount, okay? So if we're gonna use 5%, let's say, per year average appreciation, and you're just gonna have to do the math on either way you do it. When you're setting these up, you're mixing investments with mortgages and the number of things. So you want to definitely consult with an advisor, a mentor, or an attorney. So whoever you need to consult with to figure out and get yourself to a space where you're a little more comfortable with, or you can outsource it. Okay, so that's something that I do as a broker and an asset manager and investor here in the Kansas City market. This is what I do for my clients and for my partners. Okay, so keep that in mind too as you're figuring out how you want to run your investment operations. Okay, so back to the lease option, you got the upfront money, you got the lease, you got the term, how long you're going to give them. And then the key part is, okay, on that option agreement, we're going to have a certain amount that is in there. It's agreed upon with some flexibility, because you got to keep in mind when the buyer or residents become buyers, they attempt to become buyers and they get their own financing, whether it's new financing or perhaps a refi, they're gonna need to have some type of appraisal or valuation done. So in and around Kansas City, I like to use the example of a $200,000 home that's ready to go, B-class area. If I'm gonna do a lease option, I'm gonna give my residents 10 years. That, using 5% appreciation per year at the 10-year mark, I'm gonna use $300,000 as the purchase amount. Again, they're gonna have to go through the process, evaluation, the appraisal, whether it's a refi, or they're getting all new financing. I'm gonna use $300,000, okay? So again, either way, with the wrap or however you do the contract for deed or some type of note, or the lease option, it's a beautiful way to transact and do investments for those who are wanting to buy and hold property for the long run. And then, of course, the residents or buyers are responsible for the upkeep and the maintenance of the property. So it frees us up as practitioners, as investors, to be able to do whatever we choose to do with our time, besides, chasing down rent, hiring contractors to fix things, the maintenance, the tenants, and the toilets. I don't know about y'all, but a lot of the investors that I know of or know about didn't really have property management or construction experience before they got serious about investing in real estate. Well, I had that background, okay? As a broker, working with investors, as an agent early on, of course, doing the leasing and the sales, and got into property management as part of the process of being a property management firm or a CEO or owner of a property management company, which I've been in that position multiple times, working with a number of different contractors. Inevitably, you kind of go from there, doing make-readies, doing renovation, some, construction projects, right? And so for the investors who aren't necessarily familiar with how that goes, it's not exactly fun all the time. Those, as I say, are where the biggest headaches come from, dealing with the operations. A lot of that is the rehab and the property management. So if you want to perhaps avoid that or minimize it as part of your investment portfolio, and also to create more cash flow and higher returns, create more home ownership opportunities, I'm all for it, okay? So again, I'm just gonna recap. I talked about, the things that we look for as we are preparing to do a seller finance transaction. You got what's going on with the property. Is it vacant or is it occupied? Going the vacant route is key. It's a way to go. It's a very, very good way to go. So things are a lot more seamless. Then I talked about the underlying debt. If there's a mortgage on the property, it's key. It's very important. It's critical to, if you have a mortgage, to make sure that it's clean, or if you do happen to have a balloon and it's going to be important to disclose that to your residents, because it's at some point someone's going to have to exit or refi to be able to take care of that. All right. Then I talked about the price and the terms. Okay, so based on the property, based on the underlying debt, you can then have a better idea of how to structure or choose what type of seller finance transaction you want to do. Then you can come up with the price and the terms, okay? And then I forgot to mention marketing, right? So once you have all that figured out, you can then spread the word about your opportunity. And it's key because buyers, residents come quick. And when they got money and they're ready to do it, they've already been looking. Maybe they've already had experience with a seller finance transaction or lease option that didn't go over so well. So they're ready to roll. A lot of our buyers, they come with cash and they can move quick. So I can't tell you how many times over the last few years, especially as things have been started to ramp up as far as seller finance transactions up until this year. This year's been a little bit slower, but over the last handful of years, we've done a lot more seller finance transactions as a whole with my partners, with my clients, with associates than I had the previous, 8 years or so. And as we have seen more of those transactions and we've been able to prepare effectively, when we get the marketing, when we get the necessary steps lined up, and we get the marketing straight, we can find a buyer almost immediately. I can't tell you how many times where we've put the word out and within a week, sometimes a couple days, we have a buyer and we've received upfront money, a deposit, however that looks, and we're closing within 24, 48 hours. So if that sounds cool to you, holler at me. Again, ask around. It's important to consult and understand the process, which is part of the reason I'm doing these videos. And then the marketing channels. Word of mouth has been very powerful for us. There's a couple different websites that we use. Okay, we use social media, okay, to put the word out. And a key point here, before I get into the key point, I want to talk about price and terms, because that's another thing where I've received some pushback from various investors and practitioners who are intrigued by it, but they want it their way. They want what they want, and that doesn't always match up necessarily with what the market will bear. And I'm like, hey, we gotta have some flexibility in there. We can come up with the price and the terms, we can put the word out there, but if we don't hear anything for a while, giving yourself, a few weeks, maybe a month tops, then something's up. Something may be going on with the market, or we may just be asking too much down payment or upfront money, or the monthly payment might be kind of off. At this point, we've been doing this thing for a while, so we're pretty well dialed in. But if I get pushback from an investor or practitioner, I may not be able to help them, because again, it's not so much about what I want or what my client wants. It's about what the resident wants and what the market will bear and what's affordable. That's another key part. Okay, so on the marketing, a key point that I was gonna mention, and I lost my train of thought, but word of mouth has been our number one way, okay? And we're connected with a number of different agents here in town, okay, who are tapped in to certain communities with buyers who love the opportunity, they love the idea of being able to buy a home without necessarily having to immediately go through a mortgage company or the traditional route. So that's our first line of defense, and I fortunately have been able to develop some pretty amazing relationships with those agents or individuals who, once we have good product and we have reasonable price and terms for this opportunity, and if the house is vacant and ready to go, got the good underlying debt that's in place long term, we're finding buyers like that. And another key part is, there's really not much shortage for residents or people who want this opportunity, okay? And I've had pushback on the price and terms. I've had pushback from people who want us to find a buyer before they have even refied. They got a hard money loan or short-term debt, and I have to, politely say, hey, we can't help you out right now. Here's what we need lined up. Okay, so those are key parts. And then what will the market bear? All right, and then getting your marketing channels down, whether it's social media or a website, word of mouth, okay? Agents who are tapped in. There's not a shortage. We have a shortage. Where there is a shortage, excuse me, is inventory, or where there is a lack is sellers who are interested and capable and willing to be able to do this type of thing. So that's kind of where I'm at now, and that's a whole other story, is private equity being able to create more of these types of opportunities, because virtually, almost every single time that we have a good product and we have things set up straight, right, beforehand, we put the word out and it's a done deal, all right? So that's where we need more capital investors, and that's where we need more practitioners who understand this process and can see that, hey, it is a great opportunity, especially second quarter 2025 with all the volatility and all the stuff going on across the globe with the economy, with inflation, with interest rates. This can be a growing thing in the future to create more home ownership opportunities and to help those investors, because the whole investment world, owning property, transacting on real estate, There's a lot of misconceptions and misunderstandings about it. And, you know, part of my mission is, of course, is to help dispel some myths, to educate, inspire, collaborate with y'all out there. So holler at me if you want to know more how, you know, you can make it happen wherever you are. It could be outside of the US, it could be in virtually any state in the US, you could do a similar type of thing. And of course, for those investors who are wanting to make it happen in the Kansas City market, who want to place capital, collaborate, JV partner, or they just need assistance with someone helping them through the process, real estate wise, give me a shout. All right, that's it for today, y'all. Have a great day.